excited to see you all here. Um, we today have Breene Murphy to present about how to be a smart investor who cares about climate change. So without further ado, Bree, why don't you take it away?
All right. Thank you so much for having me on here. I really appreciate getting to chat with y'all. I have spoken with quite a few different student groups. So this is always a fun one, just because how to be a smart investor who cares about climate change blends over into so many different areas. So there's people that want to talk to their endowments about divestment, people who are about to get jobs. They're like, oh, what is investing? And so there's just some basics on personal level. Also, there's like a lot of implications for like, where are things going that you're investing in? And because y'all often are thinking about like, where am I going to work? Like, if I'm an engineer, like you all are, it's what kind of work am I going to do? So I'm excited to chat with that today. I am going to share my screen, get this party started. Can you all see my screen? How to be a smart investor, the green one? Yeah. All right, cool. All right. The key thing, the biggest thing in all of this that I think about is this slide. And there's different variations of it, but there's two precepts to it that are really important. One, we have to stop investing in fossil fuel extraction, and especially in expanding it. And that is, guidelines by IPCC, International Energy Agency, Project Drawdown, like this list goes on, and people are telling us like, we have plenty of infrastructure, we don't need more. Second thing is we need to dramatically increase our investments into climate solutions. The IEA, where we pulled this data from, it's $5 trillion per year. Other organizations, it can be higher. But these two things, invest way more in climate solutions and stop investing in the expansion of fossil fuel infrastructure. So those are the two things. Climate solutions, when we talk about it, are much broader than most people understand them to be. The famous ones are like solar, wind, electric vehicles, batteries, but there's a bunch more that go beyond that. Heat pumps, waste to energy, dynamic glass, water irrigation efficiency. I live in California, and the pumping of water from Northern California to Southern California is one of the most like emission heavy things we do. Reducing food waste is one of the top things. Engineers, you might be thinking about this, but like new refrigerants is one of the most effective climate solutions. So it's investing in all of those different areas. But as an individual, right, you might go get a job and you'd have a 401k. It has largely been defined by Vanguard, this world, to like basically a legal extent. They invest twice as much into fossil fuels as they invest in climate solutions. So this reality is really mixed. And even when you go into the places where they're trying to help you, you have Betterment has a climate impact portfolio, you're still seeing that is not aligned with that reality. It's only 3% of climate solutions and 5% of fossil fuels in Betterment's climate impact portfolio. So today, we want to walk through some best practices saying like, if you're not easily getting access to this, like, why do your investments matter? How should you think about being a smart investor? What are some of the myths of sustainable investing? And then tools to build your own portfolio. Then at the end, I'll give you some conclusions about how we do it at Carbon Collective, just so you have our framework. We get a little bit nerdier, but sometimes it's fun to get nerdier once you've built a foundation. Besides, it's a bunch of engineers, so like I'm sure you're like really into the nerdiness. So I want to embrace that. Big disclaimer, past performance does not guarantee future results. Investing is volatile, it goes up and down, right? And so we don't always know what investment strategies are going to play out day over day, year over year. It's more of a general trend is what I'd say. Before we get into it, I want to define a few terms: ESG versus sustainable versus impact investing. Those three concepts get thrown around a lot and conflated, and I just want to clear it up. ESG has become probably the most common. It's the E, S, and G standard: environmental, social, and governance. And it's a risk framework to evaluate investments. It was originally created as hedge funds to get an edge, more or less. So if they found out that someone was going to have big environmental risks, like Chevron has a $26 billion penalty in Ecuador, I mean, that's material to their business, right? So how likely are they to have more of that? But in these risk frameworks, you either get really messiness at the lowest levels, and then even the highest levels, it's areas that we're not in total agreement because it's a risk framework. So, for example, low end, you have BlackRock has an ESG ETF. It's called ESGU. It has Exxon in it. We think that's ridiculous, right? But at the highest levels, you have a lot of companies that do it really rigorously. They end up putting like overweighting into companies like Microsoft or Google or Apple. But we can't iPhone our way to solve climate change. And so while this is maybe part of the solution, more sustainable companies, we think it's insufficient. What we would like to talk about is like sustainable investing. And this is basically a belief, both on an ethical and financial level, that we need to be investing around climate change, where we're seeing this large scale energy transition affecting our economy. And the markets are not able to price this long-term trend into the markets. I'm sorry. I have allergies. It's like this time of year in California, where we get the dryness. And as a kid that was born in Hawaii, I have a hard time with the dryness. So just pardon me for this. Excuse me. So that's what we think of sustainable investing. Now there's impact investing too. And it's like, how is moving my money making a real difference? So, investment changes the world. What has what funding will change what we build and grow, and creating that cycle. So now we have those definitions out of the way. Part one, why investing matters. The key reason, like one of the first reasons that investing matters is voting. You're part of a small democracy when you have access to a share. A good example of like what can be done and help reimagine what is possible is engine number one. They got 3 climate friendly, board members to join Exxon's board through an activist move. This was really cool. It helped us go like, oh my gosh, this is possible. When we talk about this, this is maybe not what we think is best for the story, but we don't think it's most effective because Exxon has walked back their climate commitments since then. And they've used their cash flows not on making the energy transition, but on doubling down and owning production, which in some ways is good that they're not spending on fossil fuel expansion. So there's like a silver lining there, but it's still looking at maybe there are better ways to vote. The second thing is cost of capital. When you're growing a business, how you can get money to grow your business faster is really important. So if you have a fast growing business, I'm going to take Tesla. They had really rapidly growing stock. Everyone's like, oh, wow, this is incredible. It allowed them to get really inexpensive loans so they could build out their charger infrastructure network. And so they can just accelerate. So that's like a good example. Another one that's like less well known is Plug Power. They got $1 billion for US green hydrogen infrastructure build out. And the reverse is true. Up until the last year, oil has done much better, but oil had been doing really poorly for about 10 years. And people are talking about the high cost of capital, like how high the interest rates were going to be on the loans to do an infrastructure expansion project for oil. They're like, this is not working. Like, we can't afford this. So that's one of the reasons why your investments matter. And then probably the biggest one at our stage, right? Because we don't have large amounts of capital, as individuals, but it's just that narrative of, both what we think is not going to exist in the future, and how that affects the markets, as well as what we think will exist in the future and how that affects the markets. One thing we talk about is we still use coal right now. That exists. But because coal is starting to be outcompeted by natural gas, so many people believe that there was not much future for coal, and it dropped 99%. It is now incredibly difficult to finance and build out coal infrastructure in the United States and globally, right? It's much more difficult just because it's more expensive. This happened in people's portfolios all over, and this is the type of risk that when we're looking at the narrative, we want us to, our company, our investors, to avoid. This is getting into the myths, or the like how to be a smart investor and kind of teasing out the myths. So maybe some of you got a little bit of money and started investing during the pandemic. I don't know if that's, some people started investing in individual stocks, GameStop, that would like made a bunch of headlines. But what we've seen over time is that individual stocks trying to outperform the market is highly unlikely. This shows that there's over 5 years, like the best of the best active fund managers, only 22% outperform the S&P 500. And we look at longer timelines, it just gets fewer and fewer and fewer, right? So that's become the norm, that paradigm, what Vanguard does of buy a low-cost index fund. I don't know why this is, but there's these like Reddit threads with they're called Bogleheads, people that really like Jack Bogle from Vanguard, lots of engineers in them. So like you'll probably run into a lot of engineers in your career that like this. Low fee, highly diversified, and that is what they do in terms of passive investing. You're not picking winners or losers, you're buying a whole market or a whole index. And that was really good at first, right? Because when passive investing started coming out, there was like active long-term investors who were sending price signals. They're like, hey, I don't think this thing is going to last in 10 years. We need to get out of it, right? And short-term investors are like, they're always buying trading, like what they can get in like a day, a month, a year. And so they're all competing to send these pricing signals. But what has happened is because passive investing is so popular now, is what we're seeing is they're no longer sending pricing signals as much. They're much quieter. If 50% of the market is just buying everything, that's not really being like discerning at all. So the people who are saying, hey, what's more valuable, what's less valuable, it becomes into this group of short-term investors. And what that means in the market, this is from being like a smart investor standpoint, is that these groups of people can't price in risk, right? Climate risk, biodiversity loss. The big one that's really affecting right now is the rising cost of insurance. The other one is the declining demand of oil, which is actually on this page. But it's like, these are the opportunities on the flip side of declining demand of oil. It's like rise of electric cars. I live in California. There are electric cars everywhere. I don't know, like I see Teslas and Ford Lightning trucks, and I see Rivians, and I see Chevy Bolts. I see like the new out, like all these cars are all over the place. And so you're not really capturing that overweight, as well as in renewables and batteries. How many homes have solar in my area? A ton. So this starts to get into our argument for why sustainable investing will outperform. Because that big myth is you have to sacrifice performance to invest more ethically. And our belief is that is no longer the case for long-term investors. Looking back over time, we want to set the stage. And the person that is looking from 92 years of data from 1925 to 2017 is Jeremy Grantham. Really famous guy. He likes to study bubbles. He's manages $100 billion, a very famous investor. And what he found was if you divested from energy over 92 years from 1925 to 2017, you only suffered underperformance of 0.05%. In our investing terminology, we call those basis points. So it'd be 5 basis points, just in case you start to hear that. That is over that time period, that's not nothing, right? Like that still would result in a difference in investment, but it's not much, right? However, what we're starting to see is there's becoming a gap where fossil fuels have not been as competitive over the last 10 years. So the last 5 years of that sample that he was using, they underperformed. The most recent 5 years, they had a good year when Russia invaded Ukraine, and that decreased the supply on the market, caused oil costs to go up. That might not be the best business strategy. And so what we're seeing is there's starting to be this pull away. That is all historical, right? Up until, the data goes until the end of last month. But what about going forward? And the key thing, going back to what I was saying, is, we're in this big transition. This is a precursor transition. We went from horse and buggy to cars. This is 13 years, from 1900 to 1913. in New York City. And this is how fast, and this, like, think about how much more infrastructure cars need than just switching from cars to electric cars. You need roads, gas stations, like they're like highways across the United States. That is so much harder than saying, hey, we need charging stations. Like, you already have the roads, right? It's so much easier. So massive change where it's almost complete in 13 years. And what we're seeing is that there are these vicious and virtuous cycles. So I like to go through this one. More government, I'm sorry. More government support. We had the Inflation Reduction Act, but there's been tax credits for solar. There's been tax credits for electric vehicles for a while. More investment, more competitors are investing in these areas, more private capital is being invested, higher margins. These are more profitable businesses, higher revenues. They're growing and scaling, lower costs. It's so much cheaper to buy solar now than it once was in batteries, more public acceptance. More people have bought them early and like, yes, this is a great decision. I saved money and I have renewable energy and I don't have to deal with the volatility of buying gas from the gas station, which creates better capability, better options, more economies of scale, right? I talked to those options. There's so many electric cars out there. There's so many different types of solar panel. Like, there's a ton out there. On the vicious cycle, you're starting to see that happen with oil as well. Reverse economies of scale. The bigger they get, the harder and more expensive it is. So one of the big ones is looking at fracking. It was not a very profitable endeavor. It took $300 billion of investment, and it's sort of like a mixed bag on whether that was good. Less public acceptance, that is already happening. Higher costs. I'm not sure if you've gone to fill up your car with gas. It is expensive. Lower revenues and lower margins, that has not happened yet. So that's still high. But it's less predictable, right? Like the last year or two got a big bump from Russia invading Ukraine. Less investment, that is happening. Even when these companies have a big ton of money, we're talking $50 billion worth of like investable capital. They are not investing that in expansion, in R&D. What they did is they just bought new companies that are doing production, that are just being able to own more of the pie, and they're not trying to expand the pie. Less government support. You're starting to see policy headwinds, loss of social license. There's so many lawsuits. So this is all happening. And when you look at where they're happening, fossil fuel use is largely in two areas, the majority of their total addressable market. Transportation, cars, trucks, buses, trains, and electricity. That is like being able to turn on your lights, your utility. And the key thing is EVs are better and cheaper, right? Especially when you do the total cost. They're faster, more powerful. There's less maintenance. I have one. I've had it for 4 years. I have never taken it to the shop. All right. Like, that's so easy. It's safer. You all probably, engineers for a sustainable world, you're probably the types of people that would debunk this with your friends, but electric vehicles do not explode more than like internal combustion engines, right? Like, that's one of the ones that must drive. If I were you, I would imagine that one drives me crazy, because you're like, no, do you know what internal combustion is? It's actually an explosion. Like, every time you turn on the car and use it, it's an explosion. So like, they're much safer and there's more features. This is looking at the lifetime cost. It's coming down, and electric cars, they'll soon be cheaper to buy. That is happening in some areas already. What this is resulting in is exponential adoption. And this is only looking at 2010 to 2021, but what we're looking at is most recent data, and China, 38%. So this tops out at 8%. 38% in 2023 in China are buying electric vehicles. That's higher even in areas like Norway and Sweden. And so we're seeing this really fast adoption. All right, electricity, utility side. This is all like almost 30%, it's 20% or 28%. And just what we're seeing, so many of you almost know this, is it's just getting cheaper and cheaper to produce renewable energy compared to fossil fuels. Just on an economic basis, it's so much easier. And those headwinds that oil is facing, they're only starting to blow harder. And as a result, they're helping support solar and wind. And we're seeing these exponential bits of adoption. It starts with tax incentives, and then it gets to better production, which means more efficiency, which means lower costs, better sourcing of materials. More people start to do this. Like there's campaigns around people to adopt. There's better capabilities. You go from the Nissan Leaf that has 60 miles of charge to the Tesla Model 3 that has 310 miles of charge. So you're just seeing this rapid expansion really accelerate the adoption. And then you factor in the last thing, which is if you use oil, it's bad for the rest of your investments, right? Less predictable crop yields, more damage to critical infrastructure, rising insurance costs, less predictable real estate market, more GDP spent on disaster relief. We talk about those billion-dollar disasters are escalating, more lawsuits, that is happening, greater political instability, that is also happening. And then when the pain is bad enough, legislation will come. We are, again, also seeing this. Carbon tax, we're seeing a carbon tariff coming out of Europe that is just being implemented right now. You're going to have, there's more lawsuits. We haven't got to the end of fossil fuel subsidies, but that is probably going to happen. In summary, on this section of why we think going forward, it's better to invest in a climate smart way. Fossil fuels outcompeted in transportation, outcompeted in electricity, and they face significant legislative risk over the coming decades. That doesn't seem like something I would want to invest in if I'm going to retire 2050 or 2060. So we want to give you some tools to build your own portfolios, right? Now, we gave you both the smart side of investing as well as why it's important in the climate side, right? What you should be, what you may want to think about investing. And the thing that we find is really hard when you're going out into this world is that there's either concentrated, very narrow, not very diversified. They only hold a few stocks. It's a little bit more expensive to hold that fund, but it's really high impact. Or on the flip side, you have these sets of funds that are really diversified, but the impact is maybe not be what you want, might not be aligned with this future. So we want to talk through how you can think about that. So we'll do a little bit of a deep dive on some of these funds. This is green funds. So these are the kind of investing in the climate solutions that the IPCC, International Energy Agency, would be aligned with. You're seeing solar ETFs, clean energy. Look how narrow the percent of total market. They're under 1% of the total market. And their expense ratios are high. Now they're positive impact, right? So it gets you into this question of, okay, well, what do I do with that? Because that, if you've learned smart investing, having high diversification, you're maybe that's not a very smart investment to have everything I own in, right? And that would be true. But there are other things to do, right? So you can start to look at, okay, let's expand this idea. There's some climate funds, Etho Capital, Change Management from Grantham, and you're starting to see a little bit more market, 7.6%. It's that's a decent amount. Expense ratio is kind of a little bit better, and the impact is getting into this neutral category. And then we want to get into ESG and voting funds. This is where you can see companies like ESGV by Vanguard. It still holds some fossil fuels, but it holds 40% of the market. That's pretty powerful. That's a lot of diversification out there. Its impact though is neutral and negative, right? And then you have engine number one. When I talked about shareholder advocacy at the beginning, they're the ones that I said got the board members on Exxon. It's hard to say if that impact is good or bad because we haven't seen maybe they have slowed Exxon in what they're going to do, but they still walk back commitments. They still invested heavily in in acquisition that is about more fossil fuel production, right? So it's hard to say that it's impact, but maybe they did production over expansion of infrastructure. So maybe that's good. It's hard to say, but it doesn't seem like it's been great. Betterment's climate impact portfolio, right? So this is, we gave you a green climate ESG funds. We're going to show you what people do for you when they are trying to build this out. This is what a full portfolio would look like. And if you wanted to have some tools, you're going, okay, fossilfreefunds.org by As You Sow is one of the best places to get additional screening. So you can look at the funds that would be in if you had like your individual portfolio, or if you have a 401k at your company, they could help you better understand what's in there. One of the things that they'll highlight, though, if you have like Betterment's climate impact or something like that, is there are all these different types of problems. One of them is emerging market bonds is a sneaky area because in emerging markets, it's largely sovereign debt. That means countries are trying to get loans, and so they issue them as a bond and you buy them. But the projects they do it for are like national interest based, and that is often fossil fuel extraction. Qatar, Turkey, Saudi Arabia, Russian Federation, like these are like major fossil fuel producers. And so this is a very good example of why we don't hold emerging market bonds. And so when you see this in these portfolios that even climate impact, they're, it's a diversified portfolio, but you're still getting a lot of fossil fuels in them. And as a result, not much a reduction in CO2 in your portfolio. So now you're like, okay, I saw those funds. I know I want diversification. I know I want to invest in good stuff. Like, what are my options? So this is only on the stock side. On the bond side, it's a much narrower market. One fund that we like is BlackRock's Breene. But on the stock side, ESGV, you put it in here, it's going to be less bad, but simple and fairly well diversified. Two funds. Maybe you're like, I want some of the good stuff too. Let's do ESGV and BlackRock's iShares, right? Because even though that market coverage is only 0.2%, I'm putting more money in the things that are actually helping us make this energy transition. That is likely going to be really smart, as over my lifetime, our whole economy is going to be making the largest energy transition we've seen in 100 years. It might be a good idea to overweight there. And then three fund, this is a mix of strategies and thinking. So you would have the fossil free at the Change Research, or the iClean would be like the reinvestment. And then there's a middle one, which is Etho Capital. And they're the most sustainable companies in their industry. It's a little bit different idea in terms of how and that would be a way to have three different ones. Now, I want to talk about like what our conclusions are at Carbon Collective and then open it up for questions. So going back to the very first slide, there were two things, and we added a third, right? So don't invest in fossil fuels. So we don't. We need to dramatically invest more in climate solutions. So we do. One of the things we saw in those slides, none of those are our product. In addition to having an individual platform, we created an ETF called CCSO. It has 194 solutions to climate change. We want to have like the beginning be more focused on like things that aren't ours, so you could think about it a little bit differently. But we take money out of fossil fuels and we put it into climate solutions, and we map all the solutions from Project Drawdown to the publicly traded markets, and we include those that make more than 50% of their revenue from building solutions to climate change. And then the thing we add is we're seeing that it's just economically much smarter for us to decarbonize, have more renewables. And so as we're seeing that, like we want to pressure the rest to become more sustainable, more climate friendly. So when I talked about earlier is like the Microsofts, the Apples, like we need more companies to adopt those sort of, Microsoft has like an internal carbon price that they match against. And so if projects can reduce their emissions, they can get greenlit. So we want more companies to think like that, so they'll be more stable for the long run. When you do that to a portfolio, when you divest, you can take out, we take out 19% of the market that is responsible for 85% of emissions. And so when you look at the estimated amount of emissions, it's like we're going from 65 tons per $1 million invested down to just over 10. And these are estimates. Average portfolio fund fees, we want to keep them low, right? We get a little nerdier than what we showed you because the thing we do is we use sector ETFs, which are, so like there's 11 sectors in the economy that are mapped, and we'll buy a passive real estate ETF, a passive healthcare ETF, a passive like information technology ETF. We can get it for like 8 basis points, right? So it allows us to keep that really smart investing while keeping the fees low, right? So that's the way we do it. It allows us to have a really diverse amount of stocks, keep it inexpensive. And then this is what it looks like. So that dark green on the left, that's what we use our own ETF for, CCSO. That middle is like all those like sector ETFs. And then we have a green bond and US Treasuries. And so that is how we do it. We also offer on our personal platform just the climate only, which is like our ETF plus green bonds. That is a higher risk and reward. Probably isn't for everybody. But for some people that that's just what they want. They don't want to invest in the Amazons and the Coca-Colas and the Costcos. And the thing now that we're doing is we offer 401ks and 403bs for businesses and nonprofits, right? So, like if Engineers for a Sustainable World, it's probably a small nonprofit that employs a few people. If they were at a place where they wanted to offer a 403b, we could help them. The place of employment where you're going, if they wanted sustainable options, we could help them. And that's what we're seeing is like a new pathway to get more people to invest this way is through their place of employment. And so that is what we're working on. And we have over 100 companies that have signed up to use our 401k and 403b. So we're pretty excited. With that, questions, where are people at? I'm gonna stop share too. Amelia.
Thank you so much. I did pop off mute. I actually had a question. So a lot of our members, or all of our members, are students right now, and so their employer is sort of a university.
Right.
And I know a lot of our students are super involved in their university's divestment, protesting. Do you have any advice from someone in this field, like how to effectively change what your university is invested in?
Yeah. So there's a couple sets of places in which the university invests. One, you have your endowment, and then two, you have the employee retirement fund, right? So that's usually where they have a lot of their assets. Oftentimes the retirement is larger than the endowment. That is not uncommon. So those are the two places, and they're slightly different. I will start with the endowment since that's where the majority of employees focus, and there's a little bit more it's more likely to happen right now, is what I'd say. The key thing that I would talk to people about are some elements that we had in this presentation. Being able to talk to your endowment about how their endowment, like if they have one, I don't know what their endowment is doing, but if they have this broad market approach where they're using passive investing, you can say, hey, I don't think it's ethical for you to do this. And we're seeing that is also a risk in your portfolio. A good example is if you were in passive investing and that means you were exposed to coal. That dropped 99% because natural gas is out competing it, right? Now, renewables are out competing oil and gas, and there's demand destruction. Our endowment is at risk in addition to it's investing in a world that is not conducive for our futures. And I think that will be much more likely for someone here that's a chief investment officer of your portfolios. The other good news is there are organizations and endowment managers that do create sustainable strategies. A good example is, and I put a LinkedIn post. I wonder if I could get it really quick after I explain this, but the Nature Conservancy, they have a chief investment officer that's been looking at this, and he has a really great white paper to explain why he did what he did. I personally think there's some really strong arguments on this energy transition happening and the risks that exist in the endowment portfolios. But being able to speak to that risk, and then if you pull it out, where do you want to go? I think that's where you can also talk to like, hey, if this is the bad stuff that's being out competed, why don't we go invest more in the stuff that's winning, that's exponentially scaling? I think it's a pretty simple argument, right? Now you may need more technical details of those sorts of things. I don't know what every chief investment officer is gonna come up with, because there's so much there is differentiation between how investment officers view their total allocation. right? So I don't know what individual portfolios, endowment portfolios look like. And so I probably can't give you all the answers, but I do think those are really valuable if we're talking to the endowment. I think on employee retirement, they would probably need to have a group of professors who are like, hey, my retirement, like, I would say probably younger professors is going to help, like younger, like really good professors that the university is proud of, and go like if I were at Middlebury, I'd get Bill McKibben, right? For example. And I would go, okay, your investments and your retirement plan are in fossil fuels, and yet you're a climate scientist doing this work. Like, I can help you go to your head of benefits and talk to them. When you go to the head of benefits, they're unlikely to be the level of sophistication will be completely different than your chief investment officer. They are going to be responsible for running a really good 403b, right, which is like a type of retirement plan for universities. What you will want to talk to them about is like, hey, like this is a risk for you guys, because you are having your professors not have options that mitigate this really large risk we're seeing. Would you consider like adding like an investment advisor that would help you manage that plan? In this case, like before I was saying, like there's a bunch of endowment managers that do it. There's like, as far as I see, no one that's doing what we're doing in the retirement space. So I would be happy to talk to them. I think that would be more likely. I would say it would be better if a small university did this first. Like a university I could see doing is like Franklin Olin College of Engineering. It's a small, like it's kind of got like an ethical engineering standard. It's not huge. It hasn't been around for that long, is my understanding. Our co-founders from there, but it's like that would be a place that I could see being a really great school to try first. And you kind of have to work up until you get, start with a school that has $100 million in a 401k or a 403b, and then you go to the one that has like 250, and then you can go to the one that's got $1 billion. So like there's this perception in finance that like how big you are is how good you are. It's I would say not a particularly good proxy, because if you have a good effective team, it's something that scales very well. But it is a perception thing that I think is necessary to be aware of, right? And so that's what I'd say. So 2 different strategies, both around the risks that portfolios have being exposed to fossil fuels that are being outcompeted, right? Like it's just, you're going to have a different sort of like strategic engagement approach on each one. And that's what I would say is there. And then you can use those things when you go out into the working world, right? Like there's big, large engineering firms that are like actually really sustainably minded. They're doing really cool work. They would probably listen to that too. So I think there are options for both where you're at now. You also, like a lot of people, parents, you can talk to your parents about this stuff. There's a lot of different avenues for this. And so that's what I would share. Also, if people have questions, they can always just email me. Like, hey, I'm going to go see my endowment officer. I want to talk to him. I'll be like, okay, like walk me through how you want to do this, or what do you need from me? So I'm always available, just because like I think this is a really important information that people have. And even though I gave this presentation and I think it was absolutely riveting, most people don't remember everything in a presentation, right? It takes a little bit of time to really learn something. And so I don't expect everyone to remember everything, but I do want to make sure that they know if they want to like refresh it or whatever, they can reach out to me. What else? Sylvia, how about you? You got a question? Kevin, Andrea, either you have questions?
Yeah, I've a lot of our membership is interested in a lot of like community oriented or public oriented solutions for transportation. Like I live in Philly, so like SEPTA. Are there any similar success stories there? Like there seems to be like with electric cars and electricity, or are we kind of still on the end where it's not as renewable energy focused almost?
Ooh, that's a good question. One of the things that I have seen that I like is there have been bike and like electric scooter access programs. I think those types of things help with more mobility in short areas. It's not the same as mass transportation, but it is mass access to very light emitting transportation. So I would say that in California, that has been more popular because we don't have the infrastructure for rail systems. Like I live in Southern California, I live in Orange County. Unfortunately has a deep oil footprint. And as a result, we have as car culture as we are in the United States, there's even greater car culture in Southern California. It's a very different place. It's not like San Francisco or Chicago where you can get around. It's much harder. I'm seeing that there are bus things happening. So people are starting to have like electrifying buses. One of my favorite ones, and I'm incredibly biased because I have a 6 and a 3-year-old, are school buses. School buses are amazing to electrify because no parent wants to like get their kids on a stinky diesel bus. Like you just know that's bad for your kid, right? They run short, predictable routes. This is ideal for electrifying. There's a bunch of grants for it. So you can go, like your school district can go and get these grants. Like, so there's money available. So that's probably my favorite area. It's a real niche one, but I don't want my kids to be on like a stinky diesel school bus, right? Those things suck. So there's things like that in terms of mass transit. I'm starting to see shipping is going to get really interesting too. I know that's like maybe not what you first think of when you think of mass transit, but it is an aspect of it. I'm seeing like maritime engineers that are getting into different variations, like electric boats. But the big one is like green hydrogen and ammonia. Because so hydrogen is okay. So I'm going to share something that is more secondhand for so our co-founder James Rogolinski, this is something he talks about. But the hydrogen is going to struggle to take over like consumer transportation, cars, right? Because we don't have the infrastructure. It's really hard to put that infrastructure in. But it's not that hard to put that infrastructure into like localized ports, right? If you just did it at like the top 20 ports in the world, like you would have a lot of shipping options. So that green hydrogen I think could be really interesting, especially when you're looking at cruise lines. You're looking at like shipping containers, like container ships. Like I live in California. The Port of LA, Port of Long Beach, it is the largest port in the United States. It is gigantic. Like I see giant container ships going through. I surf, so when I go surf, I see them out in the water all the time. There's stuff like that I think is really fascinating. Alternative aviation fuels is I think going to happen. Short duration flight electric airplanes I think will probably happen. Long duration is going to be hard. Long duration is going to be hard from everything I understand. Again, I'm not an engineer. This is probably something y'all should be telling me. But I have spent enough time to like share a few things of like, let's get nerdy, with these topics, what's available. So I actually think there's a lot. Community organizing is really helpful in these things to make sure your cities, your states, like your counties, ask for these types of things. So there's that. I can't believe how bad our train culture is in the United States when we have such a beautiful country. Trains are like when I was in Europe, I went on trains. Like high-speed train would be amazing in our country. It's way behind schedule in California, but it's slated to happen. But it'd be cool if I could get up to San Francisco in an hour. I would 100% choose that over flying every time. Right? Like I don't know. Trains are way more convenient. Like you go to the train station, you get there like 9 minutes before your train gets there. You hop on the train, like you go a place. It's so easy. Airports, I hate airports. No, it's like you got to get there 2 hours early and you have to park in the weird place and you have to go through. check, and then it's like crowded, and then everyone like rushes onto the airplane as soon as you land, like everyone rushes off. Like it's a crap experience. Trains are so nice. So high-speed rail, I think that's a really big opportunity. Like I would love to take the California Surfliner, which goes up the California coast. It's spectacular. I'd love to take that up to see my friend James. Right? James is a co-founder. He lives in Bellingham, Washington. That would be like if I was able to take a high-speed rail and get there in like 4 hours, I totally would. That would be spectacular. So there is not the demand. People are not asking for that, but I do think that is possible in our country. Because I think trains are very similar to our road trip kind of nature could have a lot of overlap with trains. And that would be, for me, I think that'd be fun. Plus, if you have young kids, y'all are young, but once that happens, it's like my 3 and 6 year old, like, oh my God, the train. It's like the coolest thing ever.
Yeah, if I ever have to drive in a car again, I will be a happy camper. I think we have a question in the chat from Sylvie. Do you want to come off mute or do you want me to just read it? I can just read
it.
Okay.
Okay. So
it is.
What do you think about investing in individual stocks and renewable energy, for instance? High risk, I get that, but young people can take it. Plus, they are motivated by solving emergency. So that is possible, right? That risk, you're right, is really high. We created our ETF so that people could like have something that has all the climate solutions in it, right? So if you wanted to be that concentrated, that's why we created it, right? Because just because you're investing in renewables, like there's so many other climate solutions that are necessary to scale up. So I would say my first answer is like, it's a good learning experience. Investing at all is just a good learning experience. The second thing I would say is it is probably not as broad as you want to invest even in climate solutions or for the health of being a smart investor. So I would say it's a good place to be like, oh, this is how stocks work. I see going up and down. But if you're investing over a longer period, I would highly consider having a diversified approach that can maybe even add impact and reduce risk. So like that's what I say. And that's why I usually caution against individual stocks, even though it's an amazing learning experience. That's how I got into investing. But there's like this point where you reach and you're like, how much work do I have to do? How do I rebalance a portfolio? What other stocks should I be looking at? What should I be getting rid of? Like this question when you're buying individual stocks is like, it's hard to do and it's not as effective, right? So like, and if you're thinking about efficiency, I just don't find it as efficient over the long term. All right, anyone else? Carly, Kevin.
So a lot of our organization is made up of students, or like recent grads, young professionals. Do you have any like resources, whether that be like podcasts, blog posts, articles that are really good for kind of teaching like the basics of investing? Because I remember when I first started looking, I'm like, I have no idea what all these words mean.
Yeah. Okay, here, I'm gonna put something in the chat that will be, my goal is to be helpful. All right, so here we have a free resource on our website. In doing this, I'm starting you off on chapter 5, which is not where we start off the whole resource. Chapter 5 is written by our financial coach, Brooke Tomasetti, but it's just getting you into the basics of investing, right? If you want to start there, that's a good place. And then you can go back and look at all the other chapters. It's a much longer version of the presentation that I just gave. So and there's way more detail. There's way more cool stories and anecdotes and analogies and evidence and things like that. That might be helpful. We did publish it last year, so it probably needs to be updated in the coming years. So the data is just a little bit old. But we wanted to make sure that was available to answer that exact question.
Perfect. This is great. Thank you so much. We'll share this with the students.
Yeah, of course. Of course.
Yeah, I mean, it's a lot to wrap your head around, especially when you're brand new to it.
Yeah.
All right, we got just
Yeah,
3 minutes left.
Sylvia, you had the individual stock thing. Our climate solution stocks are all US based. They're all US index. So it's like it still would be broader than what you be talking about on an individual level. So again, I'm not saying don't do it because it's a good education. It's a good place to like look into. But what I am saying is that it is concentrated risk, and there might be ways to get access to do some similar things. That is less work and potentially lower risk over the long term. So the last thing I'd say is like, look, you're all about to go out into the working world eventually. Like, thank you so much for being an engineer for a sustainable world. I hope you really like marshal the things that matter to you, and you direct your unique skills and effectiveness to the things that are going to matter a lot. And if you have any questions, like reach out like anytime.